Hi, this is Chuck Oliver. Welcome to this week's Taxes Saved Case of the Week. Well, listen, we had such a great response to last week. And if you missed last week's, we had a client that used $30,000 to create a $300,000 tax deduction, resulting in saving them just shy of $130,000 of tax. And the number of you that have reached out, especially with the uncertainty of the Tax Cut and Jobs Act and it not maybe all being extended with the remaining months we have, folks, a lot of you have stepped up and you're finding how to save tax for yourself. So here's a different strategy we're going to talk about this week in a matter of minutes. And I'm going to go ahead and turn it over to Davis using an entirely different strategy where the client's getting a 200% return on investment over a 2-year period and saving an enormous amount of tax for her as well as her son for over her lifetime.
Yeah, thanks, Dad. Last week was really exciting. This week's, I would say, just as exciting, just a different scenario, right? So every client scenario, as we work with them on tax planning, is different, right? So we'll get into it here today. So on the left, you'll see this client's 24 tax return. On the right, you'll see this client scenario, right? So we'll break down what their client profile is here and what this tax return is really saying of all their income added up, right? So here you'll see this client, to give you the little snapshot on them, they're out of the state of Illinois. And with that, this client's just retired from the police force, as well as she's a vet, an Army vet, right? So here you'll see she had a little bit of W-2 income right before she retired last year. And then her other income breaks down. You'll see she had some great pensions for what she does, what she did in work. And the big one here you'll see on line 4B is this big IRA distribution, or in other words, a big Roth conversion we helped and strategize around for her. So all of this income added up on the left here, you see highlighted in yellow. You'll see that we're at a total of $789,892 before any strategy has been implemented for this client, leaving her a tax burden doing nothing, no strategy here, about $279,000 in a 35.4% effective tax rate. So, what do we do? Here we use a strategy that's great in tax code going back to 2006 called 181. Right? And what 181 is, and a little background on it, is most movies used to be produced in other countries like Canada, Mexico, because they're getting incentives to produce there. Well, the United States wanted to create more jobs and movies around movie production. So in 2006, they passed 181, as it existed here for now, for a good time being. So with this, right, what this deduction allows is you can invest $100,000 that generates, in what this client did, a 4.25 to 1 tax deduction, right? So that generated her a $426,680 deduction. She has 20 years to be able to use up. So this was a multi-year strategy, Dad, that we helped this client implement, where we didn't just plan for this year in mitigating taxes on Roth conversion and income, we also did for year two. So using loss limitations of our tax team, she was only able to use, but really got to use a good chunk of it, 305,000 of this deduction here in year one, as you see here on line 8, the $305,000. So what was her ROI, not just in the first year, but the second year in tax savings? We'll break that down here now. So the impact after year one with the strategy implemented of Section 181. Here, right, she had a tax before strategy of 789,000 of income, with a tax burden again of 279,000. After her $305,000 deduction, her new taxable income, as you see here on line 15, is $484,000 with a tax burden now of only 125,000. We moved her from a 35.4% effective tax rate down to a 15.8% tax rate in the first year. And that's just year one, right? So her ROI in year one, just on tax savings, again, she had to outlay 100,000 to get this deduction, but in year one, she already recouped her investment in tax savings and then some. She got 154,000 of tax savings or 154% return on investment in year one alone. But we're not done. Year two, right, what she's using this year of deduction, she has another 300,000 to Roth convert. We'll help her through that with strategy. That she's going to get another $50,000 of additional tax savings. So combining the first year of 154,000 of tax savings plus the remaining 50,000 in year two, all in all, she on a $100,000 investment in 2 years of time recouped $200,000 of tax savings, plus the long-term tax savings she'll receive by now having $622,000 of her hard-earned money Roth converted, compounding, and growing tax-free for her and her future generations to come.
You know what's great about this case, Davis? I saw somebody talking about, oh, it's time to trim your taxes. How about just eliminating unnecessary taxes altogether? Imagine getting your income and your assets out of the tax system, away from the IRS and away from Uncle Sam. And in this case, obviously, filing head of household, as you pointed out, and obviously having an adult son, she doesn't want to leave a tax burden to her son. So, folks, if you don't know the tax risk road you're traveling, go to taxessave.com. That's taxessave.com. Do yourself a favor. Watch last week, the great response from last week's case of the week. Again, a totally different strategy used than this week. This is a great strategy as well. But go back and watch that particular case study, because what's happening is the long-term effect, which we pointed out in the first case of the week study, shows the millions of dollars that are saved over a client's lifetime, and then their family's inclusive side of that for their lifetime. So go to taxessave.com. That's taxessave.com, and learn how to eliminate unnecessary taxes. And it's all done by timing, with the uncertainty of what's going to happen with the Tax Cut and Jobs Act, and technique to make sure you have proactive tax planning in conjunction with synchronizing it with your wealth planning. Taxessaved.com.